you're having that financial planning discussion where you're treating math as money, the end result is that you are invested and heavily exposed to the market. That's going to be stocks, bonds, it's going to be things out of your control.
Life does not exist on that software system or on that spreadsheet. Money doesn't work that way because money is a tangible thing. It's a spiritual thing in real life.
Money's greatest intrinsic value is its ability to give you control over your time. It is a force. It's a key. It enables you to do the things you want to do.
Just the focus on rate of return for life and everything, your money should always focus on rate of return, I think just misses the beat because I still want to have a life right now. Like this, I'm the healthiest I'm ever going to be. Why would I want to wait 30 years just to chase a rate of return rather than enjoy that money? What's up, brother? Welcome back.
Hey, what's going on? At the alert shack there, huh?
Here at the alert shack, double duty in it, serving the old flag while we record a little podcast time.
Yeah.
So I'm in this bare bones standard government bedroom with crappy furniture on a crappy desk, but pretty good use of the time.
Yeah, absolutely. That's I can picture been in those kind of just government shacks before. It's pretty bare bones. Yeah, that's cool. We recently did a little staycation here in Coronado. If anyone's military listening and you're not doing the travel reward credit card system, you got to be doing that. You're leaving so much value on the table. We stayed at the Hotel Del for free this past week and just did a midweek stay. You always get an upgrade if there's one available. So we try to find like a Tuesday or something where the chances of getting an upgrade are higher. And I'd say out of the four or five times we've stayed at the Del since we've lived here, we've got an upgrade to like an ocean view suite, 3 of them. So that was really fun. And then we're also going to Park City next month for a couple weeks and going to be using another free night. Found a pretty cool hack. I don't want to get too into the weeds on travel reward credit card skills and stuff, but we ended up getting a free night at the St. Regis Deer Valley, which is like a ballin' resort. We're not going to leave that place for 36 hours. And that was one of the more advanced level travel plays I've done with these credit cards. And when you're in the military, your fees are waived, so it's easy. Like you can systematically go through this, and we haven't paid for a flight or a hotel in like 10 years because of this. So if you're not doing that and you want to learn how, just shoot me a message or something because it's so powerful.
Are you still getting those fees waived?
Once you separate, they find out pretty quickly and they send you a notice. Amex finds out right away, and Chase takes like 6 months, it seems, to find out. But when they do, it's not like an immediate now you owe a fee. They give you a letter saying on your next card anniversary, here's what the fee will be. So I've been systematically dialing them back, which I knew I would over time. I had when I was in the military, not paying the annual fee and getting all of these huge benefits. I probably had maybe 20 cards, and you get so many travel benefits. You get all these upgrades, and you don't increase your spending at all if you're smart with it. You just like we put everything on the credit card, pay it off weekly, never paid a dime in interest over 15 years or so. But really, in the last 10 years, I think we haven't paid for a flight or hotel ever. And now I'm starting to close cards as the fees come up, and I have to be more selective about which ones we keep open. But they're still worth it, even with the fees, to have a handful of them. Not the same amount that I used to have, but it's been really fun. With this Park City trip that we're doing, just so much of it is just either free or is paid for by these cards. So
I thought if you didn't cut up your credit cards and use the envelope system, you'd be broke.
That's true. I somehow I've avoided rice and beans, despite the fact that my credit cards aren't frozen in a block of ice in my freezer. It's almost like that blanket of ice isn't applicable for many, many people, but
that's good for everybody. I think you're doing it wrong.
Yeah, that's true.
Just wrong.
Yeah. I don't know anything about you, but exactly what I've been saying for 30 years is exactly what you need to be doing, random person whose situation I don't know at all. And we've just summed up the Dave Ramsey show for you. But today, on that note, kind of like if we're taking some, obviously we're taking some shots at what we'd see as generally pretty bad advice for people that aren't broke. But there is an element to that advice, especially for people that aren't good with money, where we're not just focusing on math. And so we're going to call this money's not math, math is not money. And to take an example from Dave Ramsey that we've made before, he exemplifies that in a good way. For instance, when he talks about his debt snowball method, right? That is bad math if our goal is only the most efficient and fastest way to take a debt burden and lower it to zero, right? It's never efficient to do it the debt snowball method. However, we've talked about before that the mental stimulus or like the reward system that you need from doing that
Psychologically, yeah, it's strong. Absolutely.
yeah, and so there's validity there. What we want to talk about is money's not math. What do we mean when we say that?
Money operates typically the way that it's shown in the financial planning world on a software, on a spreadsheet. And they're using, I should say that they use a mathematical calculation when demonstrating what your money is going to do. But in reality, we don't live on a spreadsheet. We live in the world. So things happen, changes happen, economies change, emergencies come up, life changes, job changes. Who knows? Like life does not exist on that software system or on that spreadsheet. So putting a perfect calculation in this scenario and saying this is what it's going to do never represents what real life is. So your money is going to operate a certain way in many ways and when many market conditions and the way you use it and your personal behavior and the emergencies that come and things that are external and internal to your control. And math just exists. Math is, right? I can put the calculation on the page. I can prove it out. I can show you QED if you know what that is. This is what it says. Money doesn't work that way because money's a tangible thing. It's a spiritual thing in real life. And it's not completely tied to a spreadsheet and a calculation like we're typically shown.
We would say that money's greatest intrinsic value is its ability to give you control over your time. It is a force. It's a key. Like it's just it enables you to do the things you want to do. It in and of itself is not valuable for the number on the screen. The fact that it can grow itself, like passive income, all of these things don't matter when they're severed from what you actually need it for, and then beyond that, what you want to do with it to live the life you want. You have the base needs, but then what you want to do is goes a step beyond that.
And what you actually do with it. Like, have you raise your hand if you've made a mistake with your money? Like everybody listening should have their hand up if you actually did that. Like we've all screwed up. So what you actually do, the spreadsheet didn't do. So that matters too. It's not even just what you want to do; it's what you actually do.
The analogy that came to mind as we're talking through this is sort of it's like your Instagram filter, like a picture that you see on someone's Instagram versus their real life, what's behind the scenes. And I don't know how I came across it recently. I think I was like, I don't know if I was flipping through Twitter or something, but it was like a time lapse video of this girl putting on makeup. I think it was going viral because it was such a drastic difference of before and after. She was like a normal non-makeup girl, just looks normal, and then putting on super fast, but doing all this makeup. And then by the end, she just looks like your typical, like a club whore,
Unrecognizable.
Unrecognizable. And then the video worked backwards to the original, and you're like, wait, how is that even the same person? And so I kind of view that as like you sit down and you look at that projected graph of growth. The tip of the iceberg, or what you actually see on the surface, is just a nice smooth blue line that always goes up, and a little blue shading, below the actual number on the chart there. But I kind of imagine, like, if that blue shading, if you could lift it up and look at what's actually underneath and you see the real thing, there's a lot of things we're going to talk through today that will eat away at that actual, that Instagram best case scenario.
And that filtered vision, like that comes from what most people experience if they do a financial planning process. Because there's a conversation that always happens, or it might happen on air if you're just listening to a typical financial planning podcast or something, or if you sit down with somebody, at your local Edward Jones or you name it, independent, doesn't matter. And it starts with some very basic questions. They're always the same. So when do you want to retire? I don't know. I want to retire at a certain date. So here we're just going to like arbitrarily pick a number, right? Like, when do you want to retire, Hans?
Well, now I don't want to retire. Retirement used to mean 42 is when I could have retired from the military with that pension. But of course, I'm not going to stop working then. So what, second retirement is 65, because that's what the state says. If you're an airline pilot, you have a hard out where you have to stop flying. But it's not when I'm done with my utility. That's not when I'm just going to sit back and stop doing work. So like we're going to kind of lead this episode into what goes into the process, and then what the results are. How is this actually played out, and then hit on some ideas of retirement there. But in short, I don't plan to retire.
So they just pick a number. Like maybe you want to scale back at 55. and maybe you want to keep going to your 70. I don't know. And so it's always
Right.
going to look different. And then is that going to change? Does some big life event come up in your where you're like, you know what, like maybe you go through a massive death and you have to, you have this big moment, this epiphany of like, I've been doing nothing but working my whole life and I don't want to do that anymore. Yeah, that happens to
Mhm.
people. It's also they're like, I've worked my life away. I've got to shift and focus on what's important. We're never predicting that. We're never predicting the life event. It's just what age do you want to retire? Calculate with that. Then it's just like, well, how much do you make right now? And there's always an assumption there that you're just going to make the same amount of money forever. That's arbitrary. Like, are you going to change jobs 4 times? Are you going to lose a job? Are you going to get pay raises? Are you going to get bonuses? Are you going to change career paths? So again, like the money doesn't math there because the math just calculates based on this thing right now. Of course, we need projections, and then they'll go through a whole series of questions
Yep.
beyond that.
Yeah, a great one is what will your tax rate be in X number of years? Which is one, we don't know the number of years. We have to make that up. And two, we have to assume a tax rate, which literally this year, it all just changed again. And so will it change in the future? Yes, with certainty it will.
And my favorite thing about that is they always plan for it to be a lower tax bracket than you're in now, which has an implication that you're going to be drawing less money in retirement because you need less to live. And I don't know if he coined this term, but Todd Langford always says, like, how can you expect me to spend less money when every day's a Saturday?
Yep.
And it's just so true. It's just like all of a sudden, oh, I don't have anything to do all day. All the chores are done by like Monday because you have you have a whole day to do everything around your house and you do, and you're just supposed to sit and watch TV. Like you're gonna go do stuff. You're still healthy if you're 62. Hopefully, you're out there spending money. You're going out to lunch. You're going out to golf. You're doing whatever you do if you actually do the standard American retirement and stop working. So, but it's supposedly you're going to live in a lower tax bracket, which is to me kind of, I wouldn't say planning to fail. It's like you're planning to degrade your lifestyle.
Well, you're basing it off of today's income as well. And so we made the point in the past, like if you go back 30 years and someone is 65 this year in 2025, what would that be? 1995 was when they were 35 making this plan, and look at what their income was at that point. Like, do you think that they, even if they made an adjustment for the inflated cost of living, do you think that they made it to the degree that would be required over the last 30 years? Do you think that home values would have gone up exponentially, or would they have assumed a linear increase? They would have assumed a linear increase in the cost of living. And so your 1995 calculation is totally not going to get you there. And then you take a fraction of that. No.
I think when we look at the charts or when we talk real briefly about like what people have saved, because that typical conversation is always centered around putting it in a certain place, an IRA, a 401k, whatever vehicle that is, but they're all similarly situated. So it always centers around having your money there. And we're going to look at the average balances and we'll just briefly speak to what they are. So kind of demonstrates that a 65-year-old's today's plan probably didn't work based on the data we have.
If I'm going to that conversation, if I were going to go sit down with ZFP and we ask that question, you make $100,000 a year. How much do you think you'll be spending in retirement, with the assumption that you're going to get talked into the idea of spending less? 70% of that is the common answer. So they're going to plan for 70%. Let's adjust it for inflation, and maybe we'll call it 80 grand. So what I would say is, well, I'm spending 100 grand right now. If things continue at this pace, I would like to be spending about $300,000 a year, and just see, like, this system, like in that spreadsheet, that you can't account for that because you can't get there with that model. It's not in the cards.
It's not possible. Yeah. How much have you saved so far? And they're going to plug that in, and then we never talk about the behavior of that. How, again, money is not math. So
Mhm.
most people probably walk into that place. I'm gonna venture to say the vast majority of people walk into that financial planner, for one, because they haven't done much, unless they're extremely young. Let's say the average person's doing this is 30, 35 years old. They probably don't have much saved, which is why they're like, oh crap, I got to start. And we're drawing an assumption that this person just changed their behavior in a conversation. So I've saved nothing, and I'm going to put something on a spreadsheet, and you're going to get there. But we don't ever talk about, like, how do I change this behavior? How do I create this habit? Then the next thing is, and so they're going to take all that stuff without all the flaws we kind of just pointed out and punch it into either a software or a spreadsheet, and it's going to bust something out for you.
Yeah, so the assumption that's always going to be baked in there is that there's going to be a stipulated knowable rate of return. Of course, we know we can't know the rate of return, but it's all going to hinge around rate of return. And I'd say rate of return, if we have to pick like one label for the most important factor in all of this planning, it's not life, it's not adaptability, it's not resilience, it's rate of return. Everything starts with the rate of return. That's almost the sole method that these things are compared, that this strategy based off of. And so that inherently that's going to have a constant compounding with no negative years. It's going to take an average rate of return. We're going to briefly talk about the average rate of return and why it's a fallacy, why it doesn't matter towards planning, why it's not a useful metric at all. But that's always going to be the case, that you'll never see a compounding rate of return that it factors in what happens, because we can't know when the down years are going to come. We know they're going to come, but we're going to take a faulty premise, which is that your portfolio will always go up at the same rate and that you can actually get compound interest. You can't get compound interest in an investment account, in a mutual fund, in a TSP. You can't get compound interest. Like functionally, it doesn't happen because the possibility of down years. You can only get compound interest in a known, specified, guaranteed rate of return. Now, like your savings account, you could have compound interest there. We don't know exactly what it's going to be, but we know that with the rate that's set at the time, it will compound at that level until that rate changes. But we're not going to have down years in our high yield savings account. So you can have compound interest there, but you cannot possibly have compound interest in your Roth IRA if you're just investing in stocks. It doesn't exist.
And one of the reasons that I like to talk to about that, and you're 100% right, but one of the problems with that is just the terminology. Is people say that, hey, it's compounding over time. Those kind of vehicles that you're talking about, like the market vehicles, the 401ks, the IRAs, et cetera, the market assets, don't have any interest. Some of them might pay a dividend, which it's still not an interest rate. It's based on like a certain percentage on the dividend, but there's no interest rate calculations. The only thing you get is stock price appreciation. And then they talk about it as a compounding interest. Like you're going to compound at 8% per year. Like, no, you had an appreciation of a certain percent and you hope it continues to appreciate, but nothing compounded. Things just continue to appreciate in value or perceived value, which we can go down a rabbit hole of that at some point here about how a lot of it's just perceived value. So there is no compound interest. It actually does not exist in the market.
Right. In the same way it doesn't exist in your home, but that's more intuitive because we're not trained over and over. We're not propagandized to say that we get compound interest in our home, but the home value is rising or falling with other factors apart from, you could make additions to the home, but really the appreciation that you're getting when you talk about buy a home, sell it for more, which is the assumption that you're going to do, that's all based off of the value of the property going up or down independent of what you're doing. That's the same thing as a stock portfolio. You can't get compound interest in your home value, in your home price. You can't get compound interest in a stock portfolio. Like you said, it doesn't exist. And so this obsession with rate of return, it is a real thing. Like rate of return is a measurable thing. We can look back in the past and see exactly what the rate of return is each year, which is generalization based on the year, not when you entered it. But we can get those numbers. But those numbers themselves, if you go back to our rate of return article on the blog or the podcast episode we did, those actual rate of return numbers with historical certainty, we actually know the past, did not yield the average rate of return that calculating them would give us. Right. And without going too into the weeds, like go back to that episode, but just that simple example of your portfolio goes down by 50% and then goes up by 50% and you're negative, right? Even though the average is zero, we can expand that. And we'll always find that the average rate of return is going to be misleading relative to what actually happened with that data.
Yeah. Average rate of return is a useless number. And even besides that, like just talking about rate of return, like what functionally is it in your life? Like it's a great number on a spreadsheet. This is the rate of return you achieved. But what does that mean to you? If we're talking about math is not money, money is not math. What does a rate of return do for you, and what does it not do for you?
Yeah, it doesn't pay the bills, and you can't spend a rate of return. It is that blue line on the spreadsheet. It is an important and measurable value, but that's it. It's the number. If everything you were doing for money was just to get a higher number, it becomes a much more important factor than it actually is. But because we said math is not money, money is not math, we're not making money just to make more money. We're making money for its intrinsic value of allowing us to control our time. It doesn't do anything towards the controlling of our time other than what we end up doing with it. And we can't do anything with a rate of return because there's so many more things to factor in when we're looking at that measurement.
Yeah, it's kind of crazy when you think about the rate of return. And I'm going to go all the way to the end of this if somebody were retiring. And they do the simulations. They're called Monte Carlo simulations, where they take, they practice, they put all these parameters in and say, how much can you spend on a percentage basis of your nest egg and plan to live for X number of years under X number of variables. And the real common one that they've, the financial planning community has kind of tried to draw back, but they used for a long time was 4%. Now they're saying it's more like 3 in the real calculation. So sometimes under 3% for your money to last 30 years or more after retirement. But they say 4%. You could draw 4%. Even that is not a rate of return, because how are you achieving a 4% draw on your nest egg? What do you have to do to get that money? You have to sell some of the asset.
Yeah.
There's no interest calculation there unless you move it into another vehicle that pays a guaranteed interest rate somewhere, which is pretty hard to come by with some, there's annuities, but again, they're doing different things in the background. They're not actually just straight up giving you a compounding percentage. Yeah, to draw that, like you are selling assets. All you're selling is some of that hope for appreciation of the asset. There's never a rate of return, even when you start drawing money on retirement. Another thing that they never talk about. Now back to the beginning of the conversation, that normal financial planning conversation. Like, we talk about climbing the mountain with your Instagram filter of getting to this perfect place. And then they never talk about how you're going to come down the mountain as you age. It's just not part of the conversation.
Yeah. And those 4% rules, again, those assume, even when they ran those and they said, okay, against all of these different market scenarios, it would have survived like 80% of the time or 90% of the time. You would not have run out of money if you lived for 30 years under all of these market selection timeframes. But you still had to assume, when you're doing that, you still have to assume you had to go back and say, what were we actually spending each year? So we made a fixed assumption of how much you spent that year and every year had you gone through this. Now, again, when they did this study 30 years ago or whatever, do you think that they were factoring that houses now, like $800,000 house in a lot of cities is like a median house? Do you think they were factoring that you could easily spend $60,000, $70,000 on a car? When this study was done, the assumptions that were baked into this have nothing to do with reality today.
Yeah, I went with like an average 3% or so inflation rate. And they just stuck with that. Like everything was going to do this little basic inflation rate. They didn't see my grocery bills doubled since, let's say, 2020 in 5 years. Easy. I mean, of course, my kids are getting older and they're eating more, but it's still, the cost of food is easily 60% higher than it was 5 years ago. It is not following a 3%.
And real estate's doubled in the last 5 years. Like we're hockey stick levels here. And so that idea is built on an assumption of what you might be spending in those previous years when the studies run, but those are not valid studies. And here's another thing in our newsletter that's coming out in a couple of days. One of the things I wrote about was what happens to this model when lifespans increase. And so let's set aside our thoughts on, the medical industry, AI, all these things we might think about. But let's just take the premise that a lot of people in the tech and AI field think, which is that all these breakthroughs, the speed of development, the medical industry development, when AI can read and interpret, make a diagnosis with 400% greater accuracy than an actual doctor can. That's like with new tools. Let's imagine when we're 10 years down the road. The point that he made in this that I was citing was, if you're alive in 2030, the chances that you live to 100 are much greater, right, than they would be even right now. Let's just say, all these studies are the 4% rule. You won't run out of money of 30 years of retirement. If you're at 65, let's say that these expectations of lifespan based on all these developments are going to come true. Are you prepared for a 50-year retirement? If you retire at 65, what if you live to 110? And if you have uncertainty there, when is the worst possible time to realize you don't have the money? It's at the end when you're the least able to do anything about it. If I am going to live, just like I said, I sit down with a planner and they say, okay, how much money do you think you're going to want to live on? You're making 100 grand now. How much do you think you need to live on when you retire? I'll say 300 grand. They'd be like, what? No one's ever said that before. We always say less. and say, okay, well, how long do you think you want to live? How long do you plan for? You only live till 65. Let's be generous and say 95. Say, no, let's say 115. What do you got for me?
Yeah.
I need $300,000 to live because we're on the hockey stick of inflation, and I'm going to live till 115 because of these scientific breakthroughs in the medical industry due to AI improving all these elements, right? Let's say that comes true. Like,
do you think you're going to live that long?
I mean, I don't think so.
Did you get your boosters? If you want to live that long, you better go get a couple boosters.
Oh man, I have not seen a needle in close to a decade, and I'm gonna keep it that way. But like, let's just, a lot of people believe that we'll be like living past 100 will be a given with the technological breakthroughs coming through. Whether or not you agree with that, it could happen, right? We talked about AI last episode. Like, we don't know what we'll be saying about AI even in 1 year. How much will happen between now and then? We're on like everything right now. It seems like we're in the age of exponential development, good and bad, right? It's like we're kind of at the point where like the volatility, like where the pendulum is swinging so far, and once it gets to a certain point, like the swings are so aggressive. 1,000-point drop in the S&P 500 would have been like headline news even 10 years ago. And now it's like, oh, I went down 1,000 points at breakfast and it's back up, and
stocks are down on earnings. Let's see what happens tomorrow.
Yeah. And so like with this level of change, if your CFP can't answer, I'm going to live till 115 and I need 300 grand a year. What do you got for me? There is no plan for that. But what if that does happen?
Yeah. So anyway, like as you were talking about, we kind of got on a tangent there, but as you were talking about the average rate of return fallacy, and you started talking about the 50 down, 50 up, but not just that, there's all kinds of other assumptions that aren't ever made in that calculation. And just off the top of my head, like one of them is any change in your life. Like it just projects, like, and you even see it in today's world, like just 5 years ago during COVID shutdown times, I remember seeing it everywhere. People were trying to learn to be a coder for side work. They're studying, they're taking courses, they're trying to learn how to code. Nobody's going to be writing that kind of code. They're really already not doing it now, because I can go into an AI, I can go into Grok, ChatGPT, or any of those and say, hey, write me the code for this program I want, and it will do it. I don't have to learn to be a coder anymore. So we've seen one career go. Well, they don't ever make those assumptions. They don't ever say, like, what if your career just ends? No matter what it is, for any other reasons, and we have a 3-year blip here where you're not putting in this magical percentage that they say is going to get you there of your current income. What if you have a big life event? What if, you live in Florida and 2 hurricanes come and the insurance company says, we're not paying it. Like, you have to fix 50 grand in your house all of a sudden, and you're like, I can't put into my 401k for 2 years because I have to borrow from it and just pay that back. Whatever the case is, like, there's all of these scenarios where you are not just constantly putting the money in. It happens. It's going to happen to most of us. Years go up, your life goes up and down. We ride sine waves in life. Even our own lives are not a constant trajectory up. So what makes us think that our money's going to be? But it always assumes it is, right?
Yep. And half our audience can personally attest to your expectation of your career and things continuing as normal is not a valid assumption to make. Like, I did that interview with Mark Bashaw recently. He was the one court-martialed for refusing the masks and the testing and the shot. And in explaining what I do and explaining the value of what we do, I was like, you're the perfect person to talk to in this, because I don't need to throw out a theoretical what would happen if you just got fired instantly and you lost this career that you've been in for 18 years. And now you're not like, we don't have to do theoretical here. You actually did that. You got fired. You now have a record because you were sent to court martial and found guilty at court martial, although that was bullshit until Trump pardoned him recently. He had to put on any job report that he's been found guilty at a court martial, right? And so, so we don't need, it's not even theoretical for a lot of us that you could just lose your job.
What if you go to a jazz festival in Ohio and randomly get jumped and knocked out on the ground? It's like, and now you can't go to work. I have no idea what's coming in the future. And some of our audience will probably have seen videos of that atrocity. Did you see that?
I know what you're talking about.
Yeah, it's just like I don't know what's coming. I can't guarantee that I can fly airplanes in a year from now. Like, one head injury, I'm done. And that's half of our audience.
And as the migrant rate continues, the
beatings will continue.
Yeah, until mass deportations. But we have a neighbor who my daughter goes to a little homeschool co-op thing 1 or 2 days a week, with a neighbor, and it's a lot of times when either me or my wife go to pick her up, one of the girls there, her grandparents are always picking them up. Never ever seen their parents, and she's come over a few times, and we don't know exactly what the situation is, but we're 90% sure that the grandparents just fully raised the daughter, the 4-year-old daughter now.
Mhm.
And so, do you think that was baked into the plans in 1995 when they sat with the financial advisor, and they have their 2 kids, and now however it happened, we think that they are full-time raising this 4-year-old?
That was not in their plan.
No, certainly not. Let's talk a little bit more, a few points about that average rate of return and where it can be misleading as far as what your experience could be based on you could change a few tiny tweaks in that same time period, and people could have very different outcomes with the same portfolio over the same time frame. Let's say you and I both enter the same fund this year, and if we fast forward 30 years, we know exactly what the fund did. How could we have different outcomes? Because over the next 30 years and of having money in here, like, we could have different outcomes, even though we had the same fund at the same start time.
Do we have the same input?
Yeah.
Do we have the same fees?
Yeah. So about human tendencies, churning, like taking out, like missing a day, like getting scared, panic
Oh, yeah,
selling.
yeah. So it's all going to be behavioral on that point. It's not just the money aspect. Okay, yeah, yeah. So I thought you were talking about actually having different calculations. And I was like, I don't see where you're going with that. But yeah, I mean, so if we enter the same fund and I draw back 1% from what we were putting in because I have something else I need to use the money for, we're going to have drastically different outcomes. It could be anything. Anything that comes up is going to put a pivot point in that moment in time. And it could be good, it could be bad. Maybe you got lucky and you bought Bitcoin in the dip when it went to 30,000. Maybe you got excited and you sold it, when it was $5,000 because you were in early, like half of it. You have no idea what's coming, right? And that one little behavior because you wanted to go on a vacation changed the difference between being a multimillionaire right now or going on a vacation to the beach because you sold 500 Bitcoins when it was worth, $100 because you got in early. Like, I don't know,
The human elements, just we can't overlook those. Like, when something starts spiking and going viral is when people start buying it, when it's spiking up, right? You see that a lot with crypto. Like, something starts to go quote, go viral, everybody's buying it.
Yeah.
And then when it's going down, people are panic selling it, and it's like that's the opposite on both ends of what you would want to do if you're being optimal. What if we jump into the fund a week apart, and there's in between when I get in, when you get in, there's a big drop or a big climb? We're gonna have very different outcomes here, because the compounding nature of it. If you miss 1 year at the beginning, like every year you don't start, you're missing that last year of the compound curve.
The steepest point.
Yeah. Yeah. If we assume compound interest is actually applicable here, which is not.
It's a parabolic curve, meaning it starts off slow and it just continuously gets steeper and steeper over time. So the very end of it, if you could do that to infinity, at a certain point, it's basically vertical for all intents and purposes of this discussion. You're missing those years where it starts to go more towards a vertical increase. And as it rises towards that slope. So it's always, the last year is always the best year. And whenever that last year is, you're always cutting off the last year if you wait to start.
Speaking of rounding out human tendencies here, that can change the numbers on the screen, can change that filtered image. The short-term fixation that we have, where it's like, even if you're making a smart investment where, hey, this is a really solid, I've priced the risk here, it's a real estate syndicate, I think I can reliably, I'm gonna get 12%, like I feel good about this. And then you put the money in, and now it's like, okay, well, it's been 1 day. Like, we have a hard time thinking beyond a week, a month, a year, really hard time thinking 30 years down the road. And so between now and the next 30 years, are you going to be content to not make these suboptimal decisions based on the fact that, like, yeah, I got a 12% return, but I have to wait a year to realize it? It's like, one thing we see in our work is trying to get people looking past the first couple years. Everyone's focused on those first years, because we actually can present you a parabolic curve with an actual guaranteed compounding rate of return that is the whole picture. Like, yeah, we're throwing all these assumptions that are going to make the market exposed portfolio look a lot more put together than it actually is. But what we're working with clients on the savings element here is actually guaranteeing compound interest. But every year you wait to start, you're missing the biggest year yet, which is the final one.
And we can actually show you that. And the only thing that can change on that curve is that it can get steeper if the dividend experience gets better. Like it's guaranteed to go on that curve no matter what, and it can only go up higher and faster and better based on the performance of the company, but it can't ever dip. It's always
Yeah.
going to start on a basic parabolic curve. It's pretty cool. And yeah, but that is one of the. I just had a conversation yesterday with a 20-year-old. It was like I absolutely love these conversations, and like she got it right away. She's like, I just want to start this savings plan. And I even showed like, hey, here's what you see in the first couple of years when you're starting out your age. And we're thinking 25 years later, when you're in your mid 40s, what this is doing for you. And it was like it was like a breath of fresh air. And I think a big part of that is somebody that hasn't been propagandized with, I have to have a rate of return. What do you mean I'm going to put $1,000 in and not have more than that available in the first month? It's just
Yeah.
like we've been propagandized with, it has to grow, grow, grow. If there's no rate of return, if there's no immediate return, it's not powerful. And it's just like, what's it doing? We're looking here when we need to be looking here. If you're listening to me, I'm doing something with my hands. We're looking 1 year out instead of 30 years out. And I really do think that that's just what we're beaten by the media and the narratives and what wealth building is.
Yep.
It's so cool to talk. Like we have another client who's 18, and yeah, he just hasn't faced that propaganda through all of adulthood. And when you go to the workplace and everybody around you is, the proverbial water cooler standing around talking about the rate of return they get in their 401k or in their investments, and like it just slowly just gets beat into you, and that's all you can think about. And it's like, man, it was just like not even a conversation. It's a breath of fresh
Mhm.
air to see somebody that has that time span in front of them and is looking long term and thinking about it. It's such a cool thing. And yeah, you're right. Short term fixation, man, it destroys people.
And we wish when we go through the process of explaining how the life insurance contract works, policy mechanics, et cetera, usually by the end, I'd say most of our clients can look at their whole life policy and point to that as the asset that they understand the most about of all the assets they have. They've done the most research because it took kind of a rigorous rethinking of things and
Mm-hmm.
challenging yourself to get there. And some people can't get over that. But what we should do, if we're honest with ourselves, what we should all do is go back and look at what we have now and do the same thing. You
Yeah.
have this, the idea that like every day that you hold a stock in your portfolio, every day that you hold a mutual fund, a crypto, whatever, you're basically confirming that, yes, I would buy it again today. So every day that you
Yeah.
don't sell it is the saying, I would do the same decision again today. And so we get caught up in like the sunk cost fallacy where, this has gone down. So I don't want to buy any more of this. I want to get out of this position, but I'm going to wait till it comes back up. It's like, that's a logical fallacy. You're saying if it's at this price that it's at today, you would buy it again because you're committing to buying it today. Every day that you hold it, you're committing to saying, I'm going to keep the same capital here. We need to challenge all of our existing positions, all of our existing assets with the same level of rigor that people always want to and should treat whole life when they're learning about it. And so, that 18-year-old hasn't gone to work and hasn't gone pushed into a 401k without any questions asked, but that becomes the default, and it becomes so much harder to challenge the default. It's like the idea of Alex Zeck makes a great case, and this is referring to virology instead, but how the science, the virology community will approach this. And it's like this analogy he gives is, I'm butcher it, but like, so someone commits a crime in the town and they say, oh, someone says, oh, I saw George do it. And the police go and investigate George. And George is like, oh, no, actually, I was in Panama when this crime happened. And here's pictures of me and here's evidence, right? George has exonerated himself. He has all of the proof and the receipts needed to say this was not me. I wasn't even in the country. But the police then say, well, then you explain who it is. And he's like, I don't know who it is. I wasn't there. It wasn't me. Like, you're basing this off of a bad assumption, but you need to restart from the beginning. Not the assumption is that it's me until I clear myself. And so that's how they treat virology and coming up with this kind of bogus science behind it. But that example resonates here with me too, where it's like, well, why do you have that 401k? Did you actually think through that? And so when we present this and we're like, hey, you should think about a different way, they're like, okay, well, why would I do this when I can do this? And it's like, okay, yeah, give both the same treatment. Treat your 401k with the same skepticism and see if
Yeah.
it still passes muster.
Because you said that, I'm glad you circled right back to the point. There is, when you think about the common advice of just invest in the S&P because it always does this return. Well, most people have heard of the Magnificent Seven. And an interesting thing about the Magnificent Seven is every one of those has deep government ties. And I actually want to talk about this more on a full episode, but I wanted to do some more research on it before we did. is because of that, we'll call it government collusion for lack of a better term off the top of my head. They are allowed to do like a manipulation of their earnings reports where they actually, it's called guidance engineering, where they show, are you familiar, Hans?
Hmm.
Yeah, so I wanted to get like really deep into this so we can really explain it. But guidance engineering, where they can actually show like a low earning estimate, and then when they exceed it, it creates this illusion that like the company is really crushing it. The government allows them to do this. So you got the magnificent seven, and you got the mediocre 493. And most people don't know the magnificent seven is doing that, and they're really carrying 93% or more. You know, if you just think, pretend it was 100 stocks, they're carrying the whole load almost. There's occasionally charts that come out where it's like seven green stocks and a field of red around it. The mediocre 493 are not earning you the interest in the S&P 500 funds anywhere close to what you think they are without the magnificent seven, and they are manipulating their books to do so with the assistance of government. But hardly anybody's even heard of that. I've never heard somebody talk about that when they talk about investing, about how that engineering is happening. So it's just, it's like, have you done the study to look into what the stock market is actually doing and why it's trending the way it is and who's involved and what manipulation and where are the lobbyists and what's actually going on? Have you done any due diligence in those companies? Most people haven't. No fundamental analysis at all.
And that's not to say that you might do that fundamental analysis and say, hey, if I'm going to bet the government's clearly going to keep spending and the government has favored these seven companies and I'm doing my due diligence and I understand this, I understand how it's manipulated. I understand how when I buy the S&P 500, I'm not buying an ownership share in every one of the best companies in America, like this kind of idea that they talk about. No, you're hitching your wagon to seven tech companies that have favorable government contracts. And that's not a bad play to grow your money if you understand all the other implications. You understand the taxation, you understand all of these things. Like if you peel back that blue, shading below the line and it still stands up, that's fine. Like not saying we never say don't invest in XYZ, but we say do the same due diligence and apply the same skepticism criteria that you're applying to what we're teaching you, especially over the last 6 months. I'm not opposed to the idea that they're going to keep growing. Like the budget's going to continue. They're going to keep pumping money in the economy. As soon as we get a rate cut, as soon as we get, as these trade deals are coming in, tariffs did not increase inflation the way that all the economists said they would. And so, we put all this together. I don't think it's a bad play to just invest in those seven companies, but understand what that is. And like, that's the missing piece is most people don't understand that. And you're not ever going to fall into that. And so just do the due diligence on both sides.
Apple, Amazon, Tesla, Nvidia, Meta, that's the other one I was thinking of. Like those ones especially. I mean, there's Google and Alphabet and everything else, but of the seven, but all of them really are on the cutting edge of AI technology, whether that be through software or through like Teslas with robotics. And I don't think that they're going to slow down anytime soon. So I don't think it's a bad investment, but how much do you really know about what they're doing? You see where the government play is, you see what these companies are doing. It might be a worthwhile risk knowing even that they have engineered their earnings. It's not stupid, but do you even know that is the question. Like you will dig deeply into something that actually has actual compounding returns, constant compounding whole life insurance, and dig inside and out because it sounds too good to be true, versus being like, I heard Tesla's hot, buy something.
A lot of it comes back to the human tendencies of if you acted perfectly, i.e., if you could program yourself as an AI investor and you could input parameters and then forget it and remove the emotion, you would probably get a lot better outcomes than what's actually going to happen for most of us, which is FOMO. It is buying high, selling low. It's riding off of emotion and short-term thinking. So the more we can do to remove that, at least in our savings component, the more we can do to capture guaranteed compounding, actual compounding growth with a larger part of our total asset allocation, I think that's a very strong place to be to then go take those risks.
But before we get super long here, let's come back to like our rate of return and the calculations you get from the financial planner on that perfect curve. Like, tell me some things that might be through our lives more important than that, than just thinking about the rate of return I can get a stock so I can retire at a certain date. What else should we be thinking about? Like, I'm also thinking about the money's not the math. Like, there's the usability of the money, but then other than just the rate of return curve, like what else? Like, because all we're seeing is the projection of what this is, but what's happening in life? That's not the most important thing. And And then off of that, let's jump into what can impact that are that's never talked about. Like why we shouldn't just focus on rate of return. So kind of two things, like there's use of your money is sort of part of that. I was going on like what's more important. I think more than rate of return is kind of an income of some sort, whether that be some sort of passive income or something else you can do with your money, or can you get multiple uses of your money. That's more valuable to me than just a rate of return, right?
Yeah.
And we don't ever talk about that in typical financial planning. It's just like put this money away, sock it away so it gets a rate of return. But what good does that do me at 35 to 65? That's one use of that money, right? One use of that dollar. Is there another way? Like, and even on top of that, like, what's more important in retirement, rate of return or income?
Income.
Income. But we don't talk about that. We just talk about magical rate of return. So that curve, I think it just has so many fallacies. Like, that if that's all you're focused on, is like, what about the enjoyment of the money? What about being able to travel when you want to visit, to see your parents more often when you want to? But I can't because I've socked all this money away to get on the curve that the planner told me I needed. What if I can do both? What if I can do
Yeah.
something with that money now that generates income now? You know, like we've talked a little bit about options trading, for example, in a couple episodes ago. Just briefly touched on it, which again I want to get more in depth in the future. But the reason that I think that is interesting and powerful, if you learn the proper framework to do it, is it creates income, not rate of return. Right? You get a
Right.
premium on that. What about rental properties? What about loans? What about alternate investments? I mean, just the focus on rate of return for life and everything, your money should always focus on a rate of return, I think just misses the beat, because I still want to have a life right now. Like this, I'm the healthiest I'm ever going to be in theory in this moment for the rest
Yeah.
of my life. So why would I want to wait 30 years just to chase a rate of return rather than enjoy that money?
One of my favorite people to read is Vox Day. He and his wife basically, they said, people always talk about, oh, one day in retirement, wouldn't it be nice to live in a villa in Italy or something like that? People have these, what if one day we did this kind of things after we finish our working life here? He's like, we're just going to do it. And so they moved. It's probably 15 years ago, I think, but they just moved to Italy and now they're in Switzerland. And it's like just the idea of let's do it now. Why do we need to wait to do so? Like the dream that people have, why are we putting that off? And so what can you do now that what can you bring to the present that is something that's outside of like how you would normally plan for it, and how you would, in retirement, I want to do X more. It's like, okay, well, can we do that more now?
And for a lot of people, I think that this is also going to be something that it will take some grit. It will take putting your nose to the grindstone for a little while. But what can you do now? So you have this current trajectory. Maybe you work a corporate job you hate, but you're thinking about like, if I do this for 20 more years and save all this money, I can retire and live well. But what if you could put your nose to the grindstone for 2 years and create a life now that you don't want to retire from? Whatever that is. Like you say, I really would rather be doing this, or I want to invest super hard. I want to learn a ton about this thing that can earn me an income that will free me from the trap of that W-2. And it's not always a trap. You might love your W-2, but I'm saying create the lifestyle you want right now. That's what Vox Day did. He said, why wait? Like he found a way to earn income. Prior to that, he writes, he does a lot of other things. And he was able to say, like, all right, this is a life I don't want to retire from. Let's just go there. We don't have to
Yeah.
live a life we don't want to retire later. We can live a life we want now that we don't want to retire from.
I think we'll wrap up. So we're going to do a second part of this, which is kind of like the intent was, what is the process and how it's singularly focused on rate of return, how it glosses over and kind of puts this filter on it, and then what is the outcome? What are the results? And so we're going to do that in the next episode. But one of the things to wrap up with here is a few of the things that, this idea that we've said before, which is how many things have to go right for you to realize that projected return? All of them. How many things could go wrong that would derail the entire plan? And there's a lot of those as well.
Any one of them, just only one of them has to go wrong. And just
Right.
to get your brain thinking, I don't even want to tell you. I can't tell you all the things that go wrong. I mean, you could die, and then obviously everything went wrong, and it probably all went wrong for your family if you have a plan for that as well. You could get a disability.
Mhm.
You could get a divorce. I always call those the 3Ds. Those are the things that seem to bring the biggest catastrophe and life change to somebody. Your business could fail. You go bankrupt. So many things can happen, and it only takes one of those. It doesn't take all of them. You have to get all of those possibilities and all of those risks have to not happen in order for everything to work perfectly. And only one of them has to go wrong to completely shatter the wealth curve.
Yep. Your risk of disability at an earlier age is a lot higher than your risk of death at an earlier age. And if we're totally talking from the financial side of things, a disability can be worse than death because not only are you losing the income, you're not getting paid any, even if you have term insurance, you're not getting those paid out because you're still alive, but you also can't provide income, and you're also still, you require your own expense. Like you're still living. And so at least in death, it sounds callous, but at least in death, any life insurance would pay out, and the expense associated with you goes away. But disability, that's never in the conversation. And when they talk about buy term invest the difference, well, okay, you might do that and you might be on that path and you might have checked the box of if I die during this term, nobody wants to die during their term, but if you do, then you have that payout. And so that's at least better had you had that. We don't believe in that strategy, but if you did that, death would at least trigger that payout, but not disability. And that conversation is almost never ever had.
Human life value was never brought up in the conversation. So the term is probably wholly inadequate for the family going forward, especially if you die young. Nobody ever thinks about the projected income and earnings, their lifestyle. Add in pay raises, add in increased income, add in inflation. They say like 10 times your income. Well, in 2 years, that wasn't enough because your income probably would have gone up. So it's already falling short. And you just left them really with 7 years of income by the time they reach that point. Anyway, so yeah, even that falls short.
So we've got basically all of these input factors. If we distill it down to what is the goal, what is the end result of all of these factors going in when you're having that financial planning discussion where you're treating math as money, the end result is that you are invested and heavily exposed to, quote, the market, right? That's going to be stocks, it's going to be bonds, it's going to be things out of your control. And so where does this all lead? It leads to the market. What are the results? We're going to do that in the next episode. You got anything else for this one?
Nope. I'll see you with the same clothes on.
Yep, we're going to wrap this up, and then part 2 is going to be, let's check the results are in. All right, we'll see everybody next week. Cheers.